Hello, everybody. Welcome to Thursday. The S&P 500 was up 0.4% today. Was really kind of down for most of the day and then ended up at the end, had a nice run up. And really, I think, it's a good day to be up in the sense that the report from the PCE index, which is the favored measure of inflation that the Federal Reserve looks at, actually came in at a really good number, dropped again. Core inflation is down to 3.48%. Still needs to get down to 2%, have a ways to go, but the trend is there. It continues to come down. Combined with some softness in the job market, unemployment's up a little bit. We kind of need to see some softness to get kind of that soft landing. And obviously, inflation continues to come down. So the Fed is, likely, not going to be raising rates here anytime soon, as long as that continues. And that's what the market's really excited about. The other thing that's important about today is the last day of November. We ended up with a historic November, one of the best Novembers in history. And really, if you look back, to 1950, MarketWatch had a great article about how these really big months like this, when you have them, you generally have a positive month the next month. So that bodes well for December. You also end up with an average of about 14.9% return on the S&P 500 over the next 12 months. So, kind of that combination of things is just momentum begets more momentum is kind of what happens here as far as that goes. So this is a really important month, a really important move altogether from the low that was established back on October 27th. We still have not set a new high for the year that was set on the 31st of July, but I think we're going to get there. Again, I still think we'll probably waffle around before that happens, but I don't know. There's so much strength that's happening here, and I think one of the biggest things that's interesting is on the 27th. We actually did a show on the 27th. And we talked about the Bank of America survey of institutional managers, and these are the people that matter: the mutual fund managers, the hedge fund managers, they have the pension managers, they have the type of money that can move the market. At that point, according to that survey, these big institutional managers had the least exposure to stock that they'd had in the last 72 years. So obviously, they got caught, out of the market right before it was about to go crazy because it's actually up a little over 10% since the 27th of October on the S&P 500. But that's also why I think we saw such a heavy run. A lot of people trying to get back in as it took off, and so there's still a lot of money on the sidelines. According to additional surveys, we're seeing some um, exposure to stocks by these big institutions is still under what it would normally be. So there's still money to come back. I think the volume's kind of falling off just because it's moved so fast in such a short period of time. There's probably some expectations that it's going to pull back. People are just waiting, do a little bargain shopping as far as that goes, which probably makes some sense here too. So nonetheless, there's still some power to go to drive this market forward if it so desires, with inflation continuing to come down and other things kind of panning out pretty well. I don't see why it shouldn't, but you never know. There's always things that happen from the outside, and it's unpredictable. But the momentum is definitely there. So that's a really good month. We should all celebrate that month because that's something kind of historic. So tomorrow we're not doing our show, but I will do a summary. I'll put out a summary of what I saw happening for the week, and so look forward to talking to you then. Thank you very much.